Assalamu alaikum ji. After the midterm, the remaining course will be taught in this kind of video lectures on all of the material uploaded to the LMS. The first lecture of the midterm is theory of profit. As we know that we have studied in microeconomics the objective of individual entities, like we have studied the consumer. Consumer is having the sole objective to maximize the satisfaction. We have seen that how the consumer maximizes satisfaction while using a commodity when he or she maximizes the total revenue. And then we have gone to the one producer, and we have seen that the producer, how it maximizes the production level, and in that production level we have seen the laws of returns, total production, maximum total production kind of concepts. And then we have discussed the market, and optimality of the market is being said to be in the equilibrium, and equilibrium was there when the demand of the market, demand from the market is equal to the supply from the supply. So at individual level we have taught, we have read all of these issues. Now another issue which is very critical and very important one, that is the firm, theory of firm, how the firm get to the objective. We know that the economics is all by mean, it is by objective. The objective of consumer was to maximize satisfaction, objective of the producer was to maximize production, and objective of market was the equilibrium status. And now we are studying the objective of firm. Objective of firm is obviously to earn profit and maximum profit. So theory of profit we are going to start now, and obviously we have seen that the firm is having the sole objective of firm of profit, maximizing profit. Now what the firm is, the firm combines and organizes the resources for the purpose of producing goods and services for sale. A firm combines and organizes all the resources. I've told you that we are having generally we are having four kind of resources, that is land, labor, capital, and entrepreneur. And if the firm is utilizing these resources sufficiently and efficiently, and then the firm gets its objective, and the objective of firm is to get the maximum profit. Transaction and organization of the productive factors are generally accomplished by the central control of the managers. And obviously the factors of production are combined by a person who is called manager, and then manager definitely use these resources wisely and accomplishing the goals. And firms do not continue to grow larger and larger indefinitely. It means that the firm in any particular time having a limited pool of resources, and within these pool of resources we are the firm is limited to get the maximum outcome, and using these resources the firm get maximum profit. These are the main sole objective of the firm. And the firms do not primary goals to maximize the wealth and the value of the firm, and the value of the firm means the profit of the firm, in fact. And the constraint on the optimization operations, that is the primary goal of the firm is to maximize the value of wealth, so the firm subject to the constraint that faces, and the constraints that firm faces is the limited resources at per unit of time. Limited resources means that the firm at any particular unit having some amount of rupees or dollars, and it's having a limited amount of the labor, it's having a limited amount of capital. So these labor, capital, and the money is being used sufficiently by a firm, and the firm within these resources gets the maximum profit. And the limitation of the theory of firm continues with the maximization of sales. Manager seeks to maximize sales after adequate profit is earned to satisfy stockholders. Manager is always seeking the maximize sale, and these sale above the all the costs, because satisfy stockholders means that all of the cost and bills have been paid, and all of the cost and bill have been paid. No, so these expenses, if being covered, and the extra amount earned, is called profit. Maximization of management utility. Obviously, the management is having comprises with the technical staff and equipment and resources, human resources particularly, and all the agents may be more interested in maximizing the utility than maximizing the principles. If you are having resources like labor, land, capital, equipment, one has to be very careful about using these factors, and they have to get the potential outcome out of these resources. And the satisfying behavior, managers strive for some satisfactory goals, and that is obviously sale, profits, and market share. So every manager is very striving to have a maximum kind of profit. Definition of profit is very simple. Definition of profit tells that it is the difference between the total revenue, and the total cost. And this total revenue minus total cost, you may get some kind of absolute value in positive terms, in negative terms, in zero terms. If it come in positive terms, it means that the firm is getting profit, positive profit, and if the total cost become more than the revenue, it it is being called in economics a negative profit, which is equal to loss. And if the total revenue and total cost become same, what we used to use in what we say that break-even point, where the total revenue become total cost, where the profit become zero. So profit by this formula can be negative, can be positive, and can be zero. Profit are having two types. One is business profit, and business profit is the total revenue minus explicit or accounting cost of production. Business profit is equal to total revenue minus explicit cost. Explicit cost are all those money expenses which are incurred on the factor of production, and the producer is liable to pay all of the expenses and bills. Like if I'm running a farm, so I have to pay the bills, I have to pay the wages of the daily workers, I have to pay the fuel expenses, transportation expenses, I have to pay the interest. All of the payments I'm paying out of my pocket, it's explicit cost. So you can see that the explicit cost of money payments made during the production of the product in the form of rent, wages, raw material costs are easily explained. Opportunity cost of production and should be clearly recorded in the books. That is the main thing. And these explicit costs are the out of the pocket cost of production. It means that if I am producing something, so I have to first of all invest money, I have to pay some amount of money in different forms. So these expenses are called explicit cost. While on the other hand, we are having economic profits, where the total revenue minus explicit plus implicit costs. So if I'm deducting implicit cost along with the explicit cost, I am going to earn the economic profit. Now what is implicit cost? Implicit cost is actually are the factor cost of those factors which are owned by the producer himself, where the implicit cost is the factor cost of those resources which are self-owned by the producer. It means that if I am having my own building and I'm using this building in my production process, it seems that I have no kind of any rent, because it is my own building, but economically the building is being used in the process of production, and once the resource is being used in the process of production, it has to be repaid, it has to be rewarded. So whether the building is of mine, but I am the owner of the building which is being used in my process of production, but I have to pay the rent, though this rent is being paid to myself, but this amount of money should be regarded as the rent of the building. Similarly, if I am an investor, being investor, I am having a different role. I am entrepreneur, but if I am working from morning to evening, and I'm introduced myself as a paid employees as well. So wage is the reward of my labor. I have to pay wage to my efforts. So earning profit is a different thing. Earning profit is the reward of my reward of my investment, while having wage is the reward of my labor I am putting into from the morning to evening. And if some kind of amount of money is being invested by myself, it is owned by me, it has not been taken from bank, but still I have to pay the interest on these amount of money. So if these kind of explicit costs are also deducted from the total revenue along with the implicit costs, so this become an economic profit. Then opportunity cost, a term is being used widely in having the cash flows. Explicit opportunity cost, we may say that the all implicit value of the resources in its best alternative uses.